This is work done with my advisor, Brett Falk, Leonid, and Jerry, and this has been generously funded by the Uniswap Foundation as well. Cool, so yeah, so some motivation. Why do we study AMMs, right? Annually, these AMMs now facilitate about $1 trillion worth of annual volume, and then the main question that we're trying to ask is, are these AMMs efficient? Compared to sort of their traditional counterpart, these market makers like Citadel and whatnot will vary their spreads in sort of adverse market conditions. Currently in the DeFi space, we don't really have things like this for AMMs. For example, Uniswap V2, there's a fixed fee of 0.3%. This doesn't change. This is fixed. And there's really no sort of adaptation to like volatility or something in the market. So this is our central question. Should AMM fees be dynamically adjusted to reflect market volatility? And there's sort of an empirical challenge here because Uniswap V2 and V3 only have static fee pools. With V4 that just came out, this hopefully will change and maybe we can get some more data, but this is still very new. So cool. So I'll kind of try to blast through this. I assume most of you guys are familiar with what an AMM is. So this is a decentralized market maker. There's no order book needed. This is all done on chain. Through a smart contract. There's an algorithmic sort of bonding curve. This is, in our specific case, we consider the constant product curve, where we have X times Y. These are the units of the asset 1 and asset 2. These units multiplied together must be equal to some constant K. And so visually, this is what the curve looks like. And then you can see sort of like a swap visually happening like this. And in the case of Uniswap V2 I was talking about, there is a 0.3 or 30 bip fee, fixed fee on all incoming trades. Cool, so there has been a lot of work on AMMs in the past. Most of it has actually been purely theoretical, I would like to say. And kind of the challenge or the caveat with trying to determine how dynamic fees might adjust things is that the main thing is that you need fee sensitivity somehow baked into your model. So you not only need sort of strategic liquidity providers, you also need sort of fee sensitive or end liquidity sensitive trading or trading volume. We ideally like multi-period, and then we also additionally validate our results empirically. If you don't see your work up here, I'm sorry. I tried to get everyone on the guest list or the attendance list, but cool. So yeah, so our contribution is we create sort of the structural model combining what we think are all the key AMM dynamics. Then we provide sort of a generic methodology to estimate these structural parameters inside of this model using GMM. And then finally, we sort of use these parameters that we fitted to provide a framework to hopefully determine sort of an optimal dynamic fee. Cool. So let's get to the model. So just a few things to go over before we talk about the model. We're going to sort of assume that the external price process here, this is like the price on Binance or something, follows sort of this stochastic process where PT is equal to V times PT minus 1. You can think of this as V as a percentage change, and we're going to model V as a log normal distribution. Okay. There are 3 players in our model, unlike most of the other models that consider. Besides just liquidity providers and the traders themselves, we also consider the role of the platform itself. So in this case, this is like the Uniswap Foundation as well. Cool. So our game, or our model, or game, it's fairly simple, right? We just have sort of 3 time steps. The platform first comes in, they set the fee F. Then LPs arrive, they deposit some amount of liquidity, and then traders will arrive and the price is shocked. And then traders will trade accordingly to that price. So the objectives of each of these agents, the platform, we're considering, in light of how the Uniswap Foundation might think about this, is they probably want to maximize liquidity on their platform. So this is what we're considering their objective to be. For the LPs, we're considering actually that they want to have some sort of break-even constraint with respect to some baseline portfolio. We'll go over that in just a moment. And then these traders are sort of arriving endogenously based on the external price process. Maybe the volatility affects their trade volume and potentially the amount of liquidity in the pool as well. Cool. So I'm going to start backwards. We'll start with trading volume, then we'll talk about liquidity providers, and then the platform itself. This is sort of the way to think about how to optimize this. So the way we're going to model trade volume is fairly simple. The idea is we're just going to try to capture sort of the key dynamics or key intuitions of how trade volume should be affected, when fee changes, when liquidity changes, and when price volatility changes. So we just picked sort of a simple additive model here. Any A0 or subscript, these are all free parameters or structural parameters in our model that are to be estimated later. But you can see here, right, like we picked sort of this negative value for fee. This means that if fee goes up, the trade volume should go down. For volatility, it's positive. Volatility goes up, trade volume should go up. And then the important thing to note here is that this dependence on liquidity, C, is sublinear. If you have linear or higher or above linear dependence on C, you get sort of this inane result that I can deposit infinite liquidity and make infinite returns. So you sort of need this sublinear dependence on C here. But notably, right, the idea is that this model can kind of sort of be generic. It doesn't have to follow this exact structure. And really the only thing that needs to hold is, you can find the proof for this in our paper, is that the change of volume with respect to change in fee must be negative, right? If fees increase, then volume should decrease. And this is really the only constraint we need for our model for noise volume or trade volume. Cool, so the sort of break-even condition I talked about for LPs, historically, if you're familiar with sort of how people have done things in the AMM space, they've considered this buy and hold portfolio. This is how we came up with this thing called impermanent loss, right? Which is I'm putting some amount of money into the AMM pool, and then compared if I put that same money, or I didn't do anything to that same money, that same sort of distribution, I would have sort of lost money if the price moves in any direction. So that's sort of been the baseline that people use to consider. We actually consider this thing called a buy and stake portfolio. I'll call it BNS. And the idea is very similar. It's just the buy and hold portfolio. It's the same assets, but instead I'm also staking these assets. So I'm making a little bit more on top, and it's kind of the same idea. It's risk-free, and this is the baseline that we consider. Empirically, we actually find that real LP returns track this buy and stake portfolio more closely than a buy and hold portfolio. So that was an interesting insight. And one more additional thing, since the risk profiles of LPing and sort of buying this buy and stake portfolio are different, LPing I'm taking a little bit more risk because I'm betting in some sense on trade volume. We also add sort of this risk premium term, which I'll talk about in a second. And we additionally validate that this risk premium term should be constant, or at our best guess should be constant. Cool, so this is the actual break-even condition that we use. If you start with the total portfolio value of an LP is equal to the total portfolio value of a buy and stake portfolio, you can move some terms around and effectively you get this equation. And I think the best way to kind of think about this is, it's not sort of super intuitive, but sort of the fees you make as an LP should be equivalent to kind of the impermanent loss with respect to buy and stake on that same portfolio, or on that same sort of initial deposit. And yeah, so this is just kind of how the math, I guess, simplifies, but intuitively it kind of makes a little bit of sense as well. And so graphically, it just looks like this. So there's, for our specific model, we have two solutions. And the thing I want to point out here is that when we do have multiple solutions, we sort of need a way to categorize them. The green point here is what we call a stable solution. This means that small perturbations to the amount of liquidity will result, in opposite pressure. So we want to sort of return back to the stable equilibrium. And then at this red point, this is the unstable equilibrium, small perturbations will sort of result in us wanting to move away, continue moving away from that equilibrium. Cool, so you can actually solve for liquidity. You get this equation. I'm not going to read it out, but and then you can, I think, even additionally solve for sort of optimal fee if you want to. It's probably like a page long of an equation and has some ugliness in it. But this kind of brings us to sort of the next step of our paper, which is we want to actually validate, is this model any good at actually tracking how it does in the real world. Cool. So let's move on to the empirical study. So sort of our goal here, right, is to fit these structural parameters I talked about, this A0, AF, A sigma, and AC. And so we grabbed data from Uniswap itself. We looked at the ETH USDC pool on V2 from September 22nd, which is the date of the merge, up until December 2024. We used Lido and Aave for returns on ETH and USD, staked returns on ETH and USDC respectively, and we used Binance for external price data. Cool. I'll leave it at the end, I think. Cool. And so you might kind of ask yourself, like, why can't I just sort of run a linear regression on these terms and just sort of see how that fits? The challenge here is that liquidity is sort of a response to trade volume. So the correlation between this error and, I guess the log C term here is not equal to 0. So we can't really just sort of run like a ordinary least squares by itself. And so sort of the idea that we have is that we can use this break-even condition that we talked about as sort of a moment to help us identify these structural parameters. And so we use what is called the generalized method of moments. You're probably familiar with this if you do empirical stuff. If you're not, basically the idea is we have sort of these moments where we say, okay, real volume minus our model volume should be around 0 on average. And then we have a few other things. So this is returns of an LP, the portfolio value of an LP minus buy and stake, and then minus the risk premium. This should also be around 0 as well. And then we additionally do it for the real LP returns, just so we can tune the risk premium as well. And then we also convert these to unconditional moments by scaling these with current information such as lagged price volatility. Cool. So once we do this and we fit our parameters, this is the exact numbers that we get. And the standard errors are fairly good, it's about 10%. The main thing I kind of want to point out here is that trading volume is actually significantly dependent on price volatility. So this is something that's pretty interesting. Cool. So then now with our parameters estimated, we can actually try to answer this question of how should optimal fees for an AMM behave? If I want to maximize liquidity, what should I be looking, or how should I be setting my fee? And so sort of as an exercise, let's assume, we're the platform of Uniswap and we have somehow perfect information of like what I think the next time period's price volatility will be. This is sigma t here. If I do have, let's say, perfect information of this, next time period's price volatility, I can compute this impermanent loss term here directly. The math just, if I assume a log normal distribution on V times, P of t sub t minus 1, I can actually, directly solve for this impermanent loss. And then, I can actually sort of plot what the optimal fee should be if I have some sort of perfect knowledge of the next period's price volatility. So the interesting thing here to note is that, as price volatility goes up, our optimal fee should go up as well. So sort of an intuitive result, but this is, I think, a nice sort of validation. And so the last thing we haven't really talked about is how we calibrate this AF term, right? In the real world, Uniswap v2 only has a single fee tier. We've only, it's only ever been using the 30 bip fee. So we actually have no real empirical way of tuning this AF term. So this is kind of the next thing I'm going to talk about, and how do we pick these AF values, which is kind of in line with this idea of dynamic fees. With this problem in mind, if we need to tune AF, how do we do it? Well, kind of the best thing that we can do is maybe let's use a bunch of AFs, and then let's sort of simulate what a platform would be doing through our time period that we looked at, through this September 22nd to December 2024 time window. For each day, let's pretend we're the platform. We're going to forecast what we think the next day's trading volatility will be, and then that means we'll have to forecast impermanent loss, and then we're going to do this for a bunch of AF values, and then we're going to see basically which AF value on average results in the current fee that Uniswap v2 is using. And this is kind of the best that we can do to sort of get an idea of what we think fee sensitivity might be. But with v4, we might be able to actually run more experiments in the real world to actually see how trading volume affects, or different fees affect trading volume. Cool, and this is just a plot of what I was saying. Each of these points is what the optimal fee would have been if we forecasted it. And we find that 2580 or so for AF is fairly good, or fairly close to 0.3. And then finally, the last thing we want to do is we want to actually test how good this is out of sample. So this is run on data that was outside of our training window, which was from December 2024 to just, I think, last month, May 2025. And we sort of do the same simulation, right? We say we're going to pretend we're the platform. We fix AF to be this 2850 value that we calibrated. And we say, OK, I'm going to try to forecast the next period's time price volatility and set the fee accordingly to that, and see how much better I perform within the model, right? And what we find is that actually, the total amount of fees that the platform generates is about 20% extra annually, and then the average liquidity is about 5% more on average. And then this is just a plot of varying AF for that simulation. Cool, yeah, and then just wrapping up. So like I said, we have sort of the structural model. This is hopefully kind of plug and play of whatever model that you want for trade volume. Then we provide sort of this generic methodology, which is through an empirical study, right, to estimate these structural parameters. And then finally, we provide sort of this framework of maybe estimating a dynamic optimal fee. And if there's anything to take away, that it should be that AMM fees should adjust if we can make them dynamic with price volatility, and dynamic fees are indeed, it seems, better. Cool. Thank you.
Thank you. And the discussion is Matthieu Bouvard.
All right, thanks a lot for the invitation to discuss. This paper, so I was discussing with David just before, I think, doing this structural exercise is actually something which is really important. There's a good thing. So I'm a theorist. This blockchain / DeFi development has been very good for us theorists. So there's been a lot of models coming out of this new environments, but I think it's also time to see, to get these models of data and see also how quantitatively they can do, which is exactly what they're trying to do. So just in terms of context, I think AMMs have been doing, if you think of, try to kind of excellent expectations of how we thought this kind of designs could do, I think they vastly exceeded kind of the initial expectations. And that's in part because, they are, in a sense, very simple trading mechanisms. And they're competing with centralized markets, which are much more sophisticated, have much more flexibility in terms of what you can do, the type of orders that you can submit. And so, of course, so this kind of this gap in terms of flexibility is in part due to maybe just kind of design choices. You want this type of trading environments to be simple for users. It's also related, obviously, to some of the constraints that you have when you operate on a decentralized on a blockchain, which is permissionless. It's not going to give you as much flexibility as a centralized market. And so, we know there is this gap. So there, this kind of exchanges are not as flexible as centralized exchanges. But so the question is, what is the cost in a sense of this lack of sophistication, right? So, and what the paper is trying to do here is to kind of identify this cost in the model, but also quantify it, give us a sense of, so if you're in a centralized market, and you provide liquidity, when volatility changes, one thing you can do is you can adjust your quotes, right? So the kind of the bid-ask spread is going to widen because as a liquidity provider, it's going to be a way for you to protect yourself against being adversely selected. But on an AMM, you can't do that, right? So the fee, to some extent, is going to protect you against this, but this fee is fixed, right? And so the whole point here is, if you, maybe one way to kind of approximate what liquidity providers do on centralized markets is actually to have a fee which would change when volatility would actually go up, when volatility goes up. And I could actually provide benefits to liquidity providers, hence provide better incentive for those LPs to come in and provide liquidity. So the way the paper does this is they first write a model of liquidity providers. So that's the part which is really important, which is what are the incentives of these liquidity providers to come in. and to put the cryptos into these pools. And then what the model is going to give them is this relationship between the level of the fee, the level of volatility, so how much kind of this quote-unquote fundamental value of these assets are going to move, and trading volume. And the key, so the demand for liquidity, so how much traders want to swap on these AMMs, is really kind of the central object that is then taken to the data and estimated. So the core of the estimation is really can we approximate, can we estimate this demand for liquidity? And of course, then the big upside of having a structural model is that once you have this estimation, you can do counterfactuals, right? So you could look at what happens if instead of having this fixed fee level, I can actually adjust this fee level when volatility changes. Okay, so let's kind of zoom in a bit on this kind of demand for liquidity. Just as a quick reminder, which maybe is not that useful in this audience. So if you think of the LPs, they face a relatively simple trade-off, which is that on every transaction, they're going to collect a fee. And so if this transaction is not motivated by some kind of fundamental change in the value of the risky assets, so here it's swapping kind of a stable coin against a crypto, then you're actually going to make a profit. So it's relatively similar to a market maker in a centralized market. You're making profits if the trade is not motivated by some change in the fundamental value. On the other hand, you're going to make losses, so you're still going to collect a fee on traders which are trading because they see a change in the fundamental value. So in the model, that would be a change that happens in the centralized market. But there you're going to make a loss because of that's kind of this impermanent loss. It comes from the fact that essentially those guys, when they trade, they pay the correct price only on the kind of the last unit of their trade, right? But before that, they're not going to pay the correct price. They're going to pay a price which, if they buy, is too low, right? And that's going to be this impermanent loss. So that part is actually kind of captured in a very natural way in the model. Then there's kind of the other side, which is, so how do we think about this kind of liquidity traders, this kind of noise traders? And so David mentioned that they have this like fairly generic specification, which, as you mentioned, is probably can capture many different kind of more micro foundations. So for instance, the fact that you're going to have less liquidity volume and the fee goes up, that seems like fairly straightforward. Still, I mean, the part where I was kind of wondering, so how would that actually work if we were to dig a bit deeper and think a bit more on the kind of the incentives, so the reasons why these traders are here and submitting orders. So one of the things is, for instance, so there's this idea that the volume is going to go up when the fundamental volatility of the asset goes up, which holds in the data, so I'm not kind of questioning this. On the other hand, it'd be actually nice to kind of figure out exactly why this is happening. So one reason why this would be nice is that you could think of the volume going up because there's more of those liquidity trades. But it could also be that when you have more volatility in the kind of the value of the asset, you also have more of these arbitrage trades, right? And so if the proportion of these two move together, then I guess it doesn't really matter. But if it changes, then potentially, with the impact on the incentive for liquidity providers to be there, that might actually change depending on volatility. Then there's a question of the functional form of the impact of the liquidity. So you mentioned that it has to be kind of less than linear. In a sense, I mean, I think of this, maybe I'm wrong, I'm thinking of this as coming from this kind of bonding curve. Right? So it's coming from the fact that when liquidity goes up, this bonding curve is going to, your price impact is going to flatten essentially. And so it seems like, okay, I mean, log seems fine to me, but it seems like that's something you could potentially refine a bit and say it's a cost in the end, and it comes really from this kind of mechanical price impact. And so that's potentially something that you could microform. Of course, so, I mean, in the end, this is kind of flexible enough to accommodate any kind of model, but your counterfactual, for instance, is going to depend in the end on the kind of the functional form that you pick, right? So this is not completely innocuous. One thing is just I actually don't really know how to think about this, but so you think about the fundamental value of this asset as being the value on the centralized exchange. But presumably, some of the volatility in the centralized exchange is also caused by noise trading. So if it's just arbitrage, maybe it doesn't matter what's the cause of this price change on the centralized exchanges. But I wasn't exactly sure how to think about it. Okay, so liquidity providers. So this is more of a comment. So again, so David showed this equation, or at least slightly, I just moved one piece on the other side. This is just to highlight again, so some of the effect of, so this is the indifference condition for the liquidity providers, right? So this is, if this holds, you're exactly indifferent between putting your tokens in these AMMs or doing this kind of staking them essentially, okay? So what this is saying is that, so this is kind of your fee revenue per unit of liquidity. Okay, and this has to compensate you exactly for your impermanent loss plus this risk premium. And so now if you think about what is the effect of C, so suppose I move this kind of liquidity around, and you can see that it's ambiguous, right? Because on the one hand, this effect here, which is purely mechanical. If there are more liquidity providers, they're going to share the same revenue among more units of liquidity, so it's going to push your yields down. But on the other hand, you have this effect that here actually the volume of trades on the AMM is going to go up because these traders, they like the fact that the price impact is not as big. And that in a sense is already telling you why. So you have these two effects. This is kind of driving why you might actually have this multiple equilibria. And there's lots of also other intuitions you could get here. So one, for instance, is, okay, let's think about the effect of volatility. That's one of the central object in the paper. So if you think of the effect of volatility, you might think, okay, so here volatility is going to enter positively in this function. So more volatility, more trading volume. So that's actually is going to push this up. But the thing is that if there's more volatility, there's also more arbitrage. There's more, the impairment loss is going to go up. So this is actually also going up. Okay, so which way liquidity is going to have to rebalance to keep this indifference condition satisfied is something is again ambiguous, right? So highlighting the fact that taking this to the data is something which is really important. One thing also you can see here is that there is an inefficiency, right? So there is an externality. If there was just kind of one liquidity provider who would fully internalize the effect of putting liquidity on this AMM, you would actually take into account how C is changing V, right? So there should be some kind of first order derivative of V with respect to C in the kind of the amount of liquidity which is going to maximize the income of the liquidity providers, which is not there because, of course, if you're small, you're going to take this as given. Okay. So what this is saying also is that generically, the amount of liquidity is going to be inefficient in the sense of not maximizing the revenue of the liquidity providers. Okay, and so if it's generically inefficient, also, the cross effect with volatility is likely to be important, right? So the magnitude of this inefficiency, if it changes with sigma, then it's also going to justify why you may want to adjust the fee. 1 minute out. Okay, so let me then skip. I think that we can discuss later. So let me just talk a little bit about the kind of some of the implications. So here, what if I take this really literally, what I would want to do is to have a dynamic fee which is going to adjust with the volatility. One question is, okay, so how do you do that actually? So if you take this really seriously, how do you implement this on an AMM? And that doesn't seem too completely straightforward to me, right? Because what you would need is, first of all, in a sense, you need to run an estimation of your models. You need to recover these kind of parameters, this A0, AF, etc. Okay, so is this going to be stable over time? Once you deploy your AMM, it's going to be hard to change. It also requires off-chain information, right? So you're taking information from centralized exchanges, right? So how do you do this on an AMM? It's, again, not completely straightforward. Not to mention the fact it's going to make this kind of mechanism much, much more complex, right? And so, there's, I think, if that's one direction in which you could try to work and saying, okay, so maybe we cannot literally do this, but what are the mechanisms that would maybe approximate this, right? So could it be, that you have fees which are maybe not just a percentage, but maybe are convex or like multiple parts? Could we think of having multiple AMMs with different level of fees being some kind of approximation, then you could switch from one to the other? I think also telling us a bit like how you think about practically how this would be implemented, that would also actually be really useful. And then I have other comments that I skip we can discuss later. But again, I think there's a lot of things to like. In particular, pushing the social approach further than many directions, many things you could do. So I'm looking forward to the next papers, plural. Thank you.
Thank you, Matthieu.